Hi, this is Melissa Joy, and I am so pleased to be joined by my colleagues Alexa Kane and Melissa Fradenburg. And this is the Pearl Planning Economic Outlook and Investment Update for Fall Winter 2020. We're recording this on October 7th. Thank you so much for joining us, and let's just dive in. So we're going to cover 5 areas today, and I think that this is really important information that is relevant because we have so many people asking us what is going on with the economy and especially with the election coming up. What does that mean for markets? And I think that there's going to be some great information in here for everyone. And I think one of the things that surprised me is, interesting statistics that you're not going to hear on your regular news networks. So hopefully some of the information you have will give you, kind of actionable ideas. We're going to go over an update on COVID-19 plus an update on the election, where the economy is at right now and how we're kind of investing into that, and then some year-end planning ideas as well. And we will have time for questions at the end. If you have questions, I would ask you to please send them to my email, melissa@pearlplan.com, and we will provide responses to you. We just need to be able to record what those questions are. So you can send me questions along the way, or we will also prompt you again at the end of the presentation. And with that, a lot of the information that we're going to be talking to you about is coming from Raymond James. And if you remember our investment process here at Pearl Planning, we are integrating our investment strategy with the analysis of Raymond James. We love that because there is a big, well-seasoned resource team that is thinking about what is going on in the world every day, day in, day out. So that's really useful information for you to be using, and you'll see that a lot of the information we're using has come from Raymond James' most recent market analysis. Okay, I'm going to hand it off to Melissa Fradenburg first on COVID-19.
Great, thank you. Yes, I'd like to start off by just sharing some statistics on COVID-19. As you may know, the first case in China was back in November of 19, and the first laboratory confirmed case here in the US was January 20th. So it is a new virus, but we've learned a lot along the way, and it is different from the traditional flu. So we have some statistics here. One of the biggest thing is that the CDC estimates that 40% of cases are asymptomatic, and those asymptomatic cases still carry a 75% infectious rate, which really is what differentiates this virus from other viruses out there. And we're seeing this play out on college campuses. Right now, there's over 88,000 cases of COVID-19 across 1,100 plus colleges and universities. And if you look at the 10 states that have the highest rates of COVID-19 cases right now, that accounts for 56% of all colleges and university cases. So certainly that's what we're seeing here with the uptake, a lot of what we're seeing with uptake in cases, but this is no joke. The symptoms are similar with the regular flu, but if you look at the death tolls that we've seen worldwide of over 925,000, we have already surpassed worldwide influenza deaths that we see annually. So this is different from the flu. This is something to take seriously. And let's look at the current situation as far as cases that we're seeing worldwide. So it has appeared to slow and hopefully peaked as far as number of new cases worldwide. It's been trending lower since August, and as well as the new deaths. And that is good news. However, if we dig deeper and kind of look at some of the individual countries, we are seeing on the next slide an uptick, especially in Europe. So both Europe and Asia look like they could be having a second wave now. And in fact, Europe did just surpass the number of new daily cases that we saw here in the US back in the summer and late June, early July, which was our peak here. So that's definitely something we want to keep an eye out for. Again, that possibility of a second wave. And now if we look here in the US, what we're currently seeing, again, the daily new cases, we are not back at that peak that we saw over the summer, so that's good news. However, in the last 30 days, we have seen an uptick. And the good news is that positivity rate, as far as the number of people tested who are positive, has been hovering right around that 5%. And also the daily new deaths has been on a downward trend. So those are two positive things to look at. However, in the last 30 days, we have seen an uptick in hospitalizations. And if we break it down regionally here in the United States on the next slide, we'll see that certain areas, particularly looking at the Northeast because of the concentrated population in New York, New Jersey, all the states here in red are actually seeing an uptick in new cases of COVID. So it's yet to be seen whether this is in fact a third wave, but the fact that 73% of our states are seeing an increase in cases is something we want to keep an eye on. Now, our healthcare analysts at Raymond James are predicting an 80 to 90% probability of a limited use vaccine by the end of the year. So that is good news. However, what we've noticed is since the summer months, there has been a decline in willingness to receive this vaccine. So in order to get to an immunity level, we're going to need a certain amount of people to receive this vaccine once available. And what's interesting is on the charts on the right-hand side, you can see regardless of both political affiliation as well as age and gender, that we have again seen this dramatic drop-off in people who are willing to receive this vaccine if one exists. However, we are seeing rapid testing at low cost, $5 per test, with an estimate of 50 million being produced for the month of October. So along with a vaccine and more readily available testing, these are positive things when it comes to fighting this virus. Another positive we have are treatments, advancements in treatments. So some of the treatments outside of a vaccine, we have the convalescent plasma, neutralizing antibodies, remdesivir, dexamethasone, might not have had enough coffee to pronounce that one, but remdesivir is one that's been getting a lot of attention in the last week or so as President Trump, who has been diagnosed with COVID, has received that treatment. So in addition to increased rapid testing, more readily available, possibility of a vaccine by the end of the year, we have these advancements in treatments, which are all positive news. And speaking of President Trump, I'm going to pass it over to Melissa Joy to talk to you about the upcoming election.
Thanks, Melissa. I know that there's a drumbeat of questions about the election, so we're going to try to go over what's going on in prediction markets, and then also just talk about some of the hot button items that people want to discuss as it relates to this election, the economy, and markets. First, it's really difficult to see where we're at in terms of the election. You had a surprise result in 2016, and this is kind of our dashboard that Raymond James pays attention to, along with their Washington policy analysts, in terms of where you may be able to predict an outcome for the election. So you can see, from blue to red, there is varying kind of indicators when it comes to where the outcome or the result of the election will be. And in fact, the predictions are kind of purple right now. Polling has kind of morphed into also looking at betting markets, which is interesting. And those tend to be leaning toward Biden, but there's other indicators, including enthusiasm, indicators that use internet metrics, dollars raised, et cetera, as well as, the recent market rebounds that might lean toward President Trump. And so, we'll just have to wait till November 3rd or possibly after in order to know the results. But let's look at what history tells us about, who wins and what that means for markets. It's really interesting. And I think this is a kind of not conventional wisdom that regardless of party, markets tend to rise. So this is a look, Raymond James analysis, going back to the 1930s. And we're comparing in pink or red Republican administrations for the president, and in blue Democrat administrations for president. Interestingly, the market returns are almost the same. So Republicans have had an 8.6% annualized return, and Democrats have had an 8.5% annual return. There have been 8 negative GDP growth years, so that's looking at the economy, versus for Republicans versus 7 for Democrats. And the number of negative years is exactly the same. It's surprising, but this is a decent data set. This is looking back almost a century. And, you know, that's not conventional wisdom. People definitely are thinking about, you know, what will be happening in markets. But the reality is markets don't always ask who's president when they kind of mail in their returns. So I'd like to dig a little deeper too. Like, we can just look by administration. This is the annualized return by each administration going back to the post-World War II era. And when you look back, on average, Republicans have actually done better, and with this data set. But the 2 best returning presidencies of this group are Presidents Clinton and Obama. So, you know, it's a toss-up, and you'll notice that all of these presidents, excepting Richard Nixon and George W. Bush, who had, you know, the dot-com era unraveling, as well as 9/11, which were, you know, exogenous events in all likelihood. Those every other presidency has had positive equity returns. So let's talk about different areas of the market, because that's certainly something that people are thinking about. Again, there's some myths that we think are relevant to be debunked, and we've just used the last 4 administrations to show you that it's very difficult to predict what will be going on in terms of different sectors based on who's in charge. So energy is, people tend to believe, would be favored by a Republican administration, and yet returns have been better during Democrat administrations. Same goes for financials. Where, you know, we know that increased regulation, we live with it every day, would seem to indicate that perhaps it would be better to be in Republican administrations. Hasn't been the case for the last, you know, 20 plus years. Healthcare, also something, you know, especially with Affordable Care Act, et cetera, where conventional wisdom might say that it would be better to be in a Republican administration. Hasn't been the case, and both Clinton and Obama were making or attempting to make major changes in terms of healthcare during their administrations. And then information technology has really been a toss-up. So again, this is not making predictions. This is not saying what will happen if President Trump is in office for the next 4 years, or Vice President Biden. This is just telling you that trying to predict what's going to happen going forward is extraordinarily difficult. We encourage you not to do it. It tends to impact your investment returns because your behavior changes when you start to try to make predictions. And so just keep that in mind and refer back to this information rather than what you're hearing on, you know, the news channels when you're trying to think about what to do with your portfolios. Moving on, another myth is, you know, what's going to happen if we don't know who is president on November 4th. So it's with early voting, with mail-in ballots, and just with the difficulties that we've had in recent elections, kind of a hangover recollection from the Bush-Gore election. Certainly it is a strong possibility, and something that election experts are warning us about, that we may have an indeterminate period of time where the election is either contested or the outcome is uncertain. And so we do have an election to look at that's more recent. And if you're a history buff, you can see that there were other elections back in the 19th century where the outcome was undetermined. But looking back to Bush-Gore, in 2000, markets did pull back as those election results were being analyzed. But some outside events were going on at the same time. So you had, first of all, if you look on the chart on the left, you can see that September 2001 had a big decline, and we know that 9/11 happened then. Looking though specifically on the right to what was going on with markets during a sell-off that did kind of simultaneously occur at the same time as the election, there was another big event happening in the markets, which was the deflation of the tech bubble that was occurring at exactly the same time. So you can see the performance of the market is in, using the S&P 500 is in light blue, and the kind of tan color is the performance of the information technology sector. And if you take out the performance of that IT sector, then you'll see that the performance was relatively flat in the month leading up to, or the month post-election. So there were some exogenous factors in that one data set that we have to look at of a modern election that doesn't have an outcome yet. So it's not necessarily predictable that the markets would fall apart if we aren't quite sure what's happening with the election. Taxes. So there are definitely different opinions and policies when it comes to President Trump's policies and indications of the next 4 years versus the potential for Vice President Biden becoming president. And we do have a lot of information about when taxes change. And why is that? Because taxes change quite often. So first, I would point you toward our chart on the left, and you can see that there are bars up and down in that chart. Up to the highest tax rate on the chart for individuals is up close to 35%. And, it's interesting because stock markets don't behave exactly how you would expect them to behave when there are tax cuts or tax hikes. So in 1986, there was a tax cut and the market was up a lousy 2%. 1993, taxes go up, and you can see that boost in the personal tax rate. Markets are up 7%. That's kind of a head scratcher. Then you have a big tax cut in 2003, and markets did perform. They were up 26%. Keep in mind, though, that was coming out of a couple really tough years, 3 really tough years in terms of being in the market. In 2012, with the Obama administration, we had a tax hike, and the market also went up 30%. Again, that was during a recovery period, and the market probably wasn't asking what's the tax rate right at the same time, but we're not seeing a trend where markets look to where taxes are to indicate where their returns should be. And then we had a tax cut in 2017, and then markets declined by 6%. Really interesting, against conventional wisdom. But then also Raymond James took out, just basically broke down market returns for years of tax hikes and years of tax cuts. And on average, just like in general, the market is typically up 7 to 8 times out of 10. Markets were up both with tax hikes and with tax cuts. So that's not saying that if taxes go up, that the markets will also go up. It's just saying that there's not a high correlation to taxes going up, markets going down. Again, I think this information is really interesting. Markets don't ask who's president again when they get to their returns. Melissa, tell us about the economy.
Yeah, so Melissa had the hard job of talking about what the economy might do under different presidents. And I want to take a look at what the economy did do in the third quarter of this year. So as you know, in the second quarter, we had a recession. And looking back at the data, we knew it was deep and we knew it was fast. But in fact, it is the sharpest and shortest decline in history. And this graph here just kind of shows just how much of an outlier that was, what we experienced back, we're saying about 3 months, so March, April time period this year. And we had a 10% decline in our economy, which again, unprecedented both in its speed and in the sharpness of that decline. And if we look at the next slide here, what we're also seeing in the third quarter, although the official numbers are not out, our estimates are 25 to 30% in economic growth for the third quarter of 2020. And just to put that in perspective, you can see how that is likely the strongest quarter on record. So those official numbers will come out later this month before the election. But what we're looking at is some areas of the market really drove this as far as a V-shaped recovery. And those areas are in overall consumer spending. Then we had robust housing, which was also driven by the historically low interest rates. Their manufacturing had a V-shaped recovery. And then when we look at vehicle sales really picking up post-recession, there was some obvious pent-up demand there for those. So those are some of the numbers that really drove that economic growth for the third quarter. And if we look here, the letter that we feel, even though there were some V-shaped recoveries, the letter that we feel really represents the recovery of our economy is the K. And if you see, the top part looks like a V, and we have, again, those areas of our economy which either remained the same or actually took off as a result of COVID. And that would be in the technology area, hardware and storage, air freight carriers, application software, telecommunication, and household products for all those people that were hoarding toilet paper and paper towels and such during the COVID lockdowns. Now, another area over here on the upward part of the K to the right, we look at, which is, again, those areas that sort of had a V-shaped recovery. So after we came out of the initial lockdown, that would be home builders, home improvement retail, internet services and infrastructure, biotech and medical supplies. So again, really driving that recovery that we saw in the third quarter. On the bottom part of the K, we have those areas that have started to open up as those COVID-19 lockdowns have lifted slightly in areas, and we see them opening up. But if you notice, they still are areas that need to see some time for that recovery to happen, such as airlines, hotels, resorts, cruise lines, and those areas. On the bottom of the K, we see mostly the energy sector, oil and gas, some hotel and retail REITs. Those areas may not recover anytime in the near future. But again, that letter that we look at is the letter K, and our estimates for 2020 for our GDP is still negative even with that recovery, but a negative 3.3%, which is much better than it was looking in the second quarter. And our outlook for 2021 is a positive 2.7% GDP. And some more numbers on the third quarter of this year. If we look at even over the last month, so for the month of September, consumer confidence. And that's really what's going to drive consumer spending moving forward. We had the best month since 2003 as far as month over month improvement with consumer spending, or excuse me, consumer confidence. And if we look at, for the third quarter, 10 of the 11 S&P sectors were positive. So everything except for energy, which is just a sign to that tremendous recovery that we saw in the third quarter. And let's take a quick look at why that is. Why did we see that? What is driving this? One of the main things that is driving the economy after opening up is the stimulus that we saw. So if you look at, especially marked by that light blue line on the graph on the left, we actually saw consumer spending normalizing between that peak of COVID and through the end of September for all income earners. However, if you look at that light blue line, which is the low income earners, you actually see that their consumer spending was increased relative to what it was pre-COVID levels. And same sort of numbers that we see on the right-hand side, which is a measure of if people can afford a $400 cash expense by household income. And you see especially the 25,000 less and the 25 to 50,000 income earners that actually, as of July of this year, that they were able to more afford those surprise cash expenses and to pay their bills. So that again is a result of the increased unemployment that we saw in stimulus, as well as those checks that were directly mailed. Now I will mention, and we did see this play out a little bit yesterday in the markets when President Trump announced that there would not be another stimulus bill until after the election. We do still feel that it is needed, additional stimulus. And if you look at from that peak back in July, we see that personal income is down 7.4% from July through the end of September, and that the savings rate, which peaked at 33%, again, as a result of that increased unemployment, as well as the stimulus checks, is now down through to 14%. So we do still feel that further stimulus is needed to get us through. And looking back at how equities performed, one of the things I want to point out is even though all but one sector was positive for the third quarter, if we look at and actually break down those numbers, there is a huge dispersion between the best performing and the worst performing. So actually between technology and energy, there's an 80% difference in performance. So that is definitely something we're looking at. And if we look at within, not just within the industry, within industries, there is a huge dispersion. So a good example here is if you look at the chart on the right, airlines were down 45% for the third quarter, but in fact, air freight and carriers were up 47%. In healthcare, healthcare facilities were down 20%, biotech was positive 5%. So not only are we seeing a dispersion between sectors, but also within different industries. And that is something that really, when you see the difference between winners and losers like this, it really makes the case for being selective in equities. And Melissa's going to talk a little bit about what we think going forward in the equity market.
So I guess the first thing that I would mention is that we're seeing that the theory of the K-shaped recovery is occurring. We can see that with market returns over this last 6 months or year to date. So you can see that the areas of the K that we really felt like would shoot straight up, we're doing a Zoom webinar, that's a good example. Those areas are up 44% year to date, stunning numbers. Then the areas that kind of had the V where they had to take a pause, had a drop off, but then were kind of either back to normal or ahead of normal, those areas are up 22%. Those are the light blue, that's the light blue on the chart on the right. And then it's very difficult for the sectors that just kind of fell through the floor and don't have a foreseeable forecast for recovery, as well as the sectors that are publicly traded that are just lagging, where we think there is a recovery sometime and it's just not yet. So those areas are down 30% for the kind of the leg of the K, and 48% for the hardest hit sectors in purple. And yet we're optimistic, or we think that there's the potential to be optimistic. And you'll notice we're not going to address when you should be out of the market and when you should be in. We really find it encouraging to have used the process of asset allocation, of having a mix of stocks and bonds that's appropriate for you and your risk, and staying invested within those. So we're not telling you when to get out and when to get in. And we're feeling thankful that we weren't suggesting that in March and April, which were extraordinarily painful months for investors. But investor discipline was necessary in order to participate in the recovery, which was so swift. So we've got 5 reasons here, and you'll notice none of them have to do with who's going to win the election. 5 reasons, though, to be encouraged. First, we are early in this new bull market. So we had the shortest bear and short and swift, painful bear market in the first and second quarter. But we're early in, you can see on the chart on the left, the early innings of a bull market. We are super short into a time of recovery, and recoveries tend to happen for much, much longer, as you can see in this chart. Earnings growth is improving. Consensus, we're going to be getting those numbers throughout this month, and consensus is that next year earnings will improve by 26% overall. We are in a historically low interest rate environment that tends to help equity market returns. And stunning, these numbers are things that you could tell your children about someday. 76% of the S&P 500 yields more than a 10-year treasury. So again, this is good news typically for equities. And there is a lot of cash on the sidelines. So a lot of people did decide to get out. They're also asking themselves whether they should right now. As we mentioned, that is not what we suggest. But there is a lot of money on the sidelines in money markets that could potentially be invested. And, good news, if you're thinking about what do I do over the short term, the fourth quarter is typically the best quarter to be an investor. Average S&P 500 returns in the fourth quarter over the last 30 years are just under 5%. So it's the right time of the year to be an investor as well. We do have some areas of the market, and this goes back to the K that we like. We like information technology, we like communication services, we like consumer discretionary, we like healthcare. And there's areas that are part of the, difficult areas that we tend to recommend be underweighted. Interesting though, that right now the composition of the S&P 500, and even going into COVID-19, the areas that we prefer are also the largest sectors in the S&P 500. So that is, you're seeing that in why there is such a resilient recovery in the market, even though you have certain areas that are just having their knees cut out from under them. So that's a really interesting effect. And we continue to see that trend continuing with these sectors that we favor. So we want to keep that in mind. Also, when we look at the areas that how we are positioning portfolios, how we're recommending positioning, there's a preference for growth over value. This has been the past performance, but we are still seeing those trends continue. There's a story behind that goes right back to that K-shaped economic recovery. Larger companies are tending to outperform smaller companies, and a preference for the US over the rest of the world. And a preference for markets that are not as dependent upon exports. And that goes back to the US. You hear the trade numbers where we're not sending stuff overseas as much, but that tends to work in our favor in a market right now. Let's talk about bonds a little bit. Treasury yields are so low. You see it when you attempt to refinance a mortgage. You see it when you look at the yield, if you're getting any. It's pennies on the dollar when you look at your saving, if you have money in savings. But interestingly, debt is hugely up. Yields have declined significantly, but because debt is being issued by the federal government at very low yields, there's a difference between how much debt we've accrued and how much it costs to service that debt. So it's not nearly as extreme a ratio. And you can see that on the chart on the right. The net interest expense in the light blue, the line versus the bars, is not as high. It's not nearly as high as you would think. And the estimates over time, because there is so much debt that is maturing over the next 5 years, 67% of Treasury debt that can be refinanced or will likely be reissued, but at low interest rates, means that the debt servicing costs may go lower. Now, I'm not saying debt is good, and you can question how we're spending money on that debt. But what I do think is encouraging is, and it tends to indicate that interest rates will remain lower, is that reissue of the debt at lower interest rates. Then why the heck would I buy bonds or fixed income when interest rates are this low? Well, first, we've already told you that you cannot predict when markets are going to go up or go down. People did not have COVID-19 and a pandemic and the shortest bear market in history on their calendar of what was going to be happening in the investment world for 2020. And bonds do a great job when in protecting or limiting the impact of down markets. We saw that in this year. We saw that in March and April, and we want to continue to own those bonds. Also, you can own different types of bonds, so you don't have to own treasuries. Our preference is for more corporate bonds right now. And we really want you to have an investment portfolio that you can not adjust and not bail on your investment process and strategy. And with that requires bonds. So it certainly would be better if you look over very long periods of time if you only owned stocks. But typically people get wrung out and kind of bail on their investing strategy because of the high volatility that comes with the cost of an all stock portfolio. So when you look at 1 year annual return numbers by portfolio bucket, you can reduce the downside and not have to live with 30-40% drops in your overall portfolio value, which can increase the results of investor behavior. Also, we're looking at ways to invest in bonds or fixed income like instruments that aren't as correlated to either rising rates or can provide a decent return in a strange return environment. So that's kind of what we have to say about investments. I'm sorry, I'm not telling you the day to sell your portfolio and the day to buy it back again, when to go into cash and when not to. But this kind of process is what gets us through difficult, uncertain, unpredictable years like 2020. And it will continue to be the process that we recommend as investors for people that we work with. With that, I want to turn the microphone over to Alexa Kane. She's the newest team member at Pearl Planning. She's a certified financial planner and joined our team in September. Alexa, can you tell us a little bit about what we've been thinking about for year-end planning?
Oh, perfect. Yeah, thank you, Melissa, for your insights there. So we are going to be hosting a webinar specifically around year-end planning after the election is over and finalized, but we definitely want to give you guys some homework today, and hopefully it will give you some peace of mind and a little bit of control over what we can control in a time when there's a lot that is outside of that. So grab your phone, grab a notebook, whatever you want to use, but we're going to pick 2 or 3 things that we can accomplish before the end of the year. I think we have 12 weeks left, so plenty of time to get some things off our to-do list. So the first thing we want to look at is a goals review. So 2020 has certainly been a crazy year. I know when we were at the end of 2019 at New Year's, we didn't have any of this on our radar. So take a look back at what you wanted to accomplish for 2020, see where you are as far as those goals, what worked, what didn't work, and how can we use what happened to us in 2020 to guide next year and the future years. So one thing a lot of people didn't have on their goals list that really became relevant this year was having that adequate emergency fund. So it's always talked about 3 to 6 months cash reserves, but most people say, yeah, I know, and don't do it. But when years like 2020 happen and we, a lot of jobs lost, uncertainty around all of that, the need for that is so much more apparent. So all these types of things, if they weren't on your list for 2020, but they've come to the forefront now, it's a good time to reevaluate what was a priority last year and what's going to be a priority for this year and for the years to come. So with the crazy year, your goals and circumstances have, I'm sure, changed. We have a lot of job losses, job changing, a lot of people working from home now or being promoted to principal and teacher and all of that. So what you had pictured for your future might have changed. You may be thinking it's time to get a bigger house, or you need to add on a home office. There's so many things that have changed this year and adjust your plan. So it's time to take a look at what your roadmap says and if we need to make any adjustments to continue on that plan. As far as investments, Melissa talked about our steepest and quickest decline. So we saw so much volatility this year, and with that, it's important to rebalance your portfolio. And as Melissa mentioned, it's not day to day, let's sell everything, let's buy 100%, whatever the news is telling us to do. It's really a disciplined process based on your investment policy statement. So at Pearl Planning, we work really hard to make sure your accounts are being rebalanced back to the targets that you came up with in your investment policy statement. But a lot of accounts can slip through the cracks if you have 401ks, 403bs, any outside accounts. They may just be floating along and not really working for you in the best way for your situation. We also want to look at taxable investments. Take a look at them and make sure you're not paying too much in taxes for those accounts. So you really want to be careful that you're using tax efficient investments in these types of accounts, because there are capital gains and also tax implications for buying and selling. So with the volatility we saw this year, there may be losses in the accounts that you either captured earlier this year, or, I mean, we have seen a nice recovery, but there may be unrealized losses in there as well. So it's always worth a look in the account to see if there's any losses it makes sense to capture. And if you have losses that you've taken, take a look and see if it's time to realize some gains in that account, either for you have a large position you've been trying to dwindle down. It might be a good year to look at that. Education review. If you have young children, any children, grandkids too, does it make sense to open a 529 plan? It might be a good time to start saving for the education, and with the holidays coming up, it's a great gift to invest in their future. So that might be a good thing to tackle before the end of the year. Also, fill out your FAFSA. Registration opened October 1st. You want to make sure and complete that early, and don't skip filling it out just because you think it won't apply to you. You never know if you'll be eligible and what the formulas they're working off of are. Also, just be aware of the different tax credits out there for people with children and for education. The next one we have is open enrollment and benefits review. So we want to make sure we're taking control of our benefits. We have open enrollment from November 1st to December 15th. So make sure you're using what is available to you and adjusting as your situation changes. It may be time to switch insurances. If you have a growing family, have moved houses, you might want to look at getting additional life insurance, even if your company offers. It might not be adequate for where you are in your life. Another thing to just keep in mind is if you have PTO that doesn't roll over, make sure you use that, even though we're not at a place where we're taking vacations. That is a benefit to you, so use it if you have earned it. Another really great tool that a lot of companies offer with their health insurance is if you have a high deductible health plan, you can take advantage of a health savings account. And it's a great savings tool, and it's also one of the only triple tax savings advantage accounts, if that made sense. Estate planning isn't a year-end specific topic, but just with everything that's going on, the need to make sure you are covered in case you do go to the hospital or in case something happens to you has just been increased. So if you've been putting off getting your estate plans in order, bump that up to the top of your list, because the estate planning documents are something you have to do, but it gives your family or those you care about the actual gift when the time comes that something happens. Also, for the end of the year, those that are charitably inclined, we definitely want to take a look at what your strategy is around charitable giving. So when the tax laws changed a few years ago, it really decreased the number of people who were able to itemize. So there's a couple different things we can do when you're looking to give to charity. We can look at qualified charitable distributions. If you have an RMD, we can also look at donor advised funds. Or if you're on the cusp of taking the standard deduction and itemizing, we can look at bunching to take more of those charitable distributions in certain years so you can itemize then. the last thing for the estate review is with the rise of Zoom meetings and a lot of people taking advantage of the new technology to get family members together that are far away. It's a great time to set up a virtual family meeting and talk to your kids, your grandkids about your philosophies on savings, investing, giving to charity, and also, those other conversations around where are my accounts, where are the important documents, and who's going to be in charge when that time does come. So a lot in that section that's not exactly timely, but it's, going to get cold out and we're going to have a lot more time to be spending at home, and a good project to tackle there. For retirement savings, we want to be aware of deadlines and confirm what type of accounts we're utilizing. Some accounts require deposits to be done before the end of the year, such as your 401k and 403b, and other accounts allow until the tax filing deadline for contributions to be made. Either way, want to make sure you're on track and making the proper election should you do traditional versus Roth if it's available in your plan. The end of the year, it's also a really great time to evaluate your current savings and if that's enough to meet your goals. One thing that's really great is if you're trying to get your 401k contribution up, it's a lot easier to say increase by 2% now and 2% in July to slowly get yourself up to that goal of 10% than to go from 3 to 10 just in one day. So maybe take a look and see if there's room in your budget for a small increase and bump up your long-term savings there. For everyone's favorite taxes, the CARES Act suspended RMDs for 2020, but just because you don't have to take from that account doesn't mean that you shouldn't do anything before the end of the year. If you are charitably inclined, you can still complete qualified charitable distributions directly from your IRA. It also might be a good year to complete a Roth conversion if you are of RMD age, or even if you're younger. You're at a lower income rate this year, it's something we would want to consider. So it's great to see, a lot of people had changes in income this year, either increases or decreases, where there are some planning opportunities around taxes and, a couple months to work with CPAs and get that stuff figured out. So a lot of stuff to consider, but hopefully you found 2 or 3 things that you can take action on before the end of the year, and a couple other things to do. If we can go to the last slide.
Should be there.
Perfect, sorry. I had a little delay. So, of course, map out the last couple weeks of the year and get to work on all the things you have to do. Current clients, schedule a call with us to address any changes to your goals, if we need to look at different tax strategies, or if you need help with estate planning or 529s. Follow Pro Planning on social media. We've got a lot of great podcasts, blogs, everything coming out, and we also will have a full year-end planning webinar coming up post-election. And get on our newsletter list.
Thank you so much, Alexa. So glad to have you on the team. And as I was listening to all the great financial planning kind of content outside of investments, what it reminded me of is this has been an extraordinarily intense year of financial planning work. And when we were living through the crazy change of the world in March, our mantra really was and continues to be focused on what you can control. It's so easy to get distracted by predictions of the future, what's going to happen to my money. And I think that sometimes can take more energy than the, kind of just rolling up your sleeves and getting to work when it comes to financial planning. And so having a reminder that your money is not just your investments and it's not just the returns of the market yesterday or today, but it's the compounding returns of good financial decisions. And that's what can really help you to achieve your goals. I would love it if anybody has questions for them to email me right now. I'm checking my emails as we speak. And I just would ask Melissa Fradenburg first, before we start the questions, what have you been thinking about financial planning versus investments as you kind of get into this time of year? How do you kind of keep the investment worries out of your mind in order to focus on what you can control?
Yeah, well, I mean, that is key. And that's what ran through, excuse me, my mind as I was listening to Alexa was if your goals haven't changed, if your goals, and everyone, even if you're looking at retirement, you still have long-term investment goals because you need your money to last you through that period, which may be 30 plus years. So to be focusing on a 3-month period or even a 6-month or 1-year period when your goals and your time horizon are really 10 years plus out is just unneeded stress. So really that's what I love about financial planning and what we do for our clients, because we are able to focus on those long-term goals and really, offer some peace of mind in that sense that we're not looking at what your portfolio is doing in the next 3 months or 6 months, or what if we don't know what's going to happen in the economy. We do know over time, if you have, again, asset allocation, proper asset allocation, and looking at what your time horizon is, that we can ease some of those fears and help you with those unknowns.
Yeah, I think with busy families, with trying to manage and integrate financial decisions across generations, at a certain point, either your time gets too limited or the tasks become more complex. And that's really our role, is to integrate both, the balance that you need to be thinking about, responsible investing as well as responsible financial decisions. It's a pleasure to do this work. And it's certainly, we have a lot of fun doing it. I don't see any questions, so that's nice, but we know that you will be having them over time. So first of all, if you have friends who you think would enjoy this webinar, make sure to share it with them. It will be up on our website shortly, just a couple days lag there. And we'll also make sure to send it out to everyone in our newsletter. And then we also will notify you when future presentations are coming. So we are going to have that year-end financial decisions presentation. We'll also have resources for you after the election. We'll make sure to be extra communicative, both on social media, available for phone calls. We've still got a lot of year left in 2020, so that's important for us to remind you. And then here is all of our contact information in Dexter and Grosse Pointe in both of our offices. And we know we have clients all around the country. So thank you for using this virtual format to listen in from 3 different zip codes it happens to be today as we're recording. And of course, we want to make sure to include our disclosures at the end. So thanks so much. We will keep you posted as things change in markets, the environment, everything that changes. And we just appreciate that you are a part of the Pearl Planning family. And thanks for tuning in. Have a great day.